It's so neat to hear the way you're laying it out. In 2023, 2024, a lot of people don't like to talk about that part of the future, but you mentioned geopolitical unrest and some of those things. I've been hearing it too because in our area, right, that we're very close with the bankers and tightening up is scary. Getting out of this one day is also, not going to be an easy thing, right? This is a very large change that's happening. It's just going to be harder and harder until what, 2025, because we need a president and, it's just going to be pure chaos for a bit.
Yeah, yeah. We've got, the whole election cycle coming up. Midterms, they're kind of done for at this point because of inflation. But the real, 2024 election cycle is going to be where you're going to see that's where it's going to get interesting, where political pressure will be put on the Fed and Treasury to do some things. So it'll be fun to watch that. The big thing right now is we have so much unprecedented stuff going on out there in the housing market. We've never seen record low inventories while demand destruction is happening. And rates are not quite there yet, but they're getting ready to. Once they cross 7%, they're shooting up, 6.5, 6.6 or something today.
Yeah.
So, that's putting a lot of pressure on the housing market, but there's still a lot of pockets that are unfazed. So we've never seen that before. We've got a very healthy borrower in residential real estate. Record low levels that they've locked themselves into as far as interest rates go. 70% of loans, I think, are sub 4%, 30 years. Another 10% or sub 3% for 30 years. So you have people that are locked into their houses because of that. And then, where your biggest risk and your biggest exposure is in the commercial market, more specifically in the multifamily market, because a lot of these deals that were done over the last couple of years at, 2, 3 forecasts with bridge debt, that's coming due. So that's what I'm talking about, where your opportunity is going to come from. Wherever you've seen these, interest-only loans that were short-term that were done for, 3 years, 5 years, they have to re-up. They're not going to be able to. They're not going to be able to get out of that because the values are gone. We've seen record rent increases, so that's kind of helped offset a little bit. But cap rates are going up. So a lot of these assumptions that a lot of these deals were done by, just aren't going to be able to work out at the end. So those deals may be ripe to be taken over, and that's going to wipe out all the equity investors in those deals. When you take something over like that, so that's what happens. When a deal goes to a bank and it's under stress and somebody takes it over, equity gets wiped out and you're taking it over for the debt. And there's a lot of big funds out there on the sideline that are raising cash for distressed debt, corporate and in commercial real estate.
So help me bring this point out for a second. You mentioned the area, the street, the block, the neighborhood. Cap rates can be negligible sometimes with looking at the right street and block. And if you have some other properties there, things like that. And you don't need, when you're a new investor, even if you're somewhat seasoned, you're not looking for 50 properties. You need 1 win or 2 wins. And that's, that takes a little bit of time to be able to do it. So, I kind of want to stress, you'll still get the deal. It's just a lot more work. And underwriting is difficult already. Underwriting further to, you're going to lose deals now, because you can't go high enough and things like that. Right?
Yeah.
What changes?
There's been a lot of competition, a lot of pressure on cap rates. And again, because the institutional money, we're looking for yield and chasing those deals. So, and then you have the syndicators. And, over the last couple of years, we've seen a lot of people just get into, especially multifamily, but other assets as well, and equity. So, equity capital funds, same thing, chasing yield, chasing deals. And, they're borrowing money to go, buy up and roll up assets like self-storage or car washes or, whatever, and then turn around, package them and flip them to another fund. So that yield is shrinking as rates are going up in other areas, as cap rates expand, interest rates expand. It's all about the cost of capital. So at the end of the day, the only assumptions that you can make are, well, I can increase rents another 20, 30% because that's what they went, the last couple of years. That's not going to happen. So we're reaching critical mass in rents. That's the other thing you have to look out for, especially residential. So multifamily, mixed use properties, we've seen rents go up 30, 40% over the last couple of years. That's what everybody was ignoring in the inflation numbers. We've all been screaming about it, going, these inflation numbers that they're reporting are not correct because rents are lagging in their numbers. Now they're starting to hit the inflation numbers and they're sticking. Rents aren't coming down. They're continuing to go up because these deals are getting done. That's the only way they're going to work. So when this comes to, fruition and they have to, re-up and they can't, the only thing they can do is raise rents to kind of, carry the asset as long as they can.
Yeah.
But at some point, people, they can only afford what they can afford. So they quit paying or they move. And, there will be pushback at some point. And there already is in some markets. That's why I say every market's different. You go into some markets in Florida where rents have increased so much on multifamily and housing, people are moving. There's a lot of area that you can move into in Florida that's close to where you need to be, but far enough away where it's cheap. And, we saw this in 08, 09. If you remember in 08, 09, everybody wanted to be in the cities and everything close into the cities like, Philadelphia area, DC area, big metros. Real estate spiked exponentially close in when the recession hit. Everybody moved out to the suburbs because it was cheap. Gas prices did that. When gas prices were through the roof, what was that, 2014, 15, somewhere around there, everybody started moving closer in. So it drove real estate prices close to the cities because of the commute. And, and then that reversed in the pandemic. So, real estate's a funny thing. That's why I say it's state, city, neighborhood, block, street, and position on that street. A cap rate can change right around the corner, depending on what's going on with that asset, that geography, schools, crime, all the different things. And then, now with rents where they've gone, that's causing people to have to move. So it'll be interesting to see how far that goes. I mean, typically it's been 30% of income, allocated towards housing costs. I mean, we're pushing 50% in a lot of areas, and that's putting a lot of stress on people, which reverberates through the economy. You have real estate slowing down, transactions,
Sure.
mortgage brokers struggling, real estate brokers struggling, and everybody else that's party to those transactions. You have the construction industry that's contracting, so, I mean, all of these things are going to put pressure on the overall economy, but it takes time. So this isn't doom and gloom. This is just, these are the things that are playing out in real time in front of us. And if you look at the markets, you can see how they're kind of slowly reacting and kind of unwinding into this. And if you go back and look at 2008-9, you see the exact same thing until the banks collapsed, and then bam, you had that final drop. Then the government stepped in and started propping companies up, started, buying distressed debt and assets off the books of the banks that were in distress and foreclosure. And, literally buying stock and propping companies up and then dropping rates and, doing everything that they did. We had no inflation. So they could do it. So we never fully worked the system and let everything reset without intervention. Go back to 2001, dot-com bubble, same kind of thing. Everything super bubble peak. And then, things kind of started rolling over the cliff a little bit, and all the indices and, as the economy repriced. This go around right now with inflation where it's at, the Fed can't intervene. They might be able to do some things with, maybe some foreclosures and, a couple of companies, we've seen them, bail out airlines and things like that. But they're not going to be able to come in and drop rates back to zero. They're not going to be starting QE again because can't. Inflation will do more damage to the economy than the market collapsing. And it'll also create serious civil unrest. And when you look around the world of what's going on right now, you see people marching in the streets and taking over, overthrowing. I'm not saying that can happen in this country, right, as far as overthrowing the government, but people will take to the streets if they can't feed their families, if they can't afford shelter. That will create mass protests, and then people will just stop paying like they did in China. You'll see that. Other countries, you're seeing actual regime changes where people are trying to overthrow the government. So Iran's erupting right now. We saw Venezuela. We saw, a couple of these other countries, where these things are happening in real time right now. So it's very polarizing times around the world right now.
I mean, this goes right back to what we were talking about at the beginning of this, banking changing and getting ahead of it, right? This is a, I don't like to say it's a fearful time, but it's an overly educate yourself time.
Yeah, it's a time to just really, so, I'm an optimist, right? I'm opportunistic. I've started a dozen companies, built them up, sold them off. I've done, hundreds of millions of dollars in real estate. I'm a developer, so I take a lot of risk, and I'm used to, big risk, big reward. But there's also times where you have to be cautious. You have to be cautiously optimistic, and you have to just risk off. So we're just in a risk off environment right now. So sometimes, just like 2008-9, you have to let the dust settle. And, this is all positive, by the way. I'm just laying things out that you need to be aware of and understand, because the opportunities are going to come just like they did back then. So I was put out of business as a builder in 2008-9 because nobody was building. I was on the Outer Banks of North Carolina. Nobody was doing anything. And, but I pivoted. So instead of being a builder where I'd build a house for you, I started building little spec houses and selling. And that was still working because they were expensive. People could pay cash. A lot of people still had cash during that time. So I made a little business doing that, and then opened some restaurants, and I did some other things and took advantage of, opportunities. Restaurants were closing after 2008 and 9. So, space was abundant. So I could walk in, take over restaurants with no money, get them up and running very quickly with little investment. Those were great little opportunities. Same thing in real estate. Instead of building multi-million-dollar houses, I started building little, $100,000, $200,000, $300,000 beach houses and selling those. And then I jumped into the markets for the first time in the bottom of 2009. I was fortunate enough to have a friend that worked on Wall Street prior to moving to the Outer Banks. And he's like, man, he said, this is generational opportunities in the market right now. He said, this move right here will put your kids through college. So that's the first, time I entered the markets right at the bottom of 2009 when the Dow was at 6,000, S&P was 600. And, people thought I was crazy, or maybe it was 3,300. I can't remember. I'd have to go back and look what the lows were. Yeah, I meant like 6,600.
That makes you hard.
Yeah. So, I'm not afraid to take risk at the right time. So this is what I'm saying. We're still at the beginning. So if things play out, this is the beginning of a bear market. We haven't even seen, where things can go. And we're kind of where we were in that beginning cycle of 08, 09, and where we were in the beginnings of the dot-com 2000, 2001. And it's just cycle. It's just business.
Yeah. And I think that's the most important message of this whole podcast. There's somebody like Greg who has made it through a bunch of these things. And the way you talk about this matrix, it's just very neat to hear. But you make yourself available to people. How does someone get a hold of you to talk to you?
Yeah. GregDickerson.com. So, I don't do consultations, but, I do coaching and mentorship, but that's a formal program that's on my website. But it's GregDickerson.com is where all my info is. I do have courses on real estate and entrepreneurship and other things. I do have coaching and mentorship, but I have a YouTube channel that I'm putting out content and videos every day as
Love
well.
So
that's where you can get what I'm looking at, what I'm thinking, how I'm viewing, what's going on right now. And I put it in context of my experience in 2008 and 9, because it's very relevant right now, what's going on as it was back then, not from a banking crisis standpoint, from how the banks are going to react. Because everything I'm saying, if you went behind the scenes and sat, at the board meetings of the banks, loan committees, this is what they're talking about. When they're looking at your loan, they're going, all right, now wait a minute. We've got this going on in this neighborhood over here. These things are happening. The economy's doing this. The Fed's raising rate. That's how they're sizing loans and measuring risk, because that's what they do. That's what loan committees do. 3 months ago, it didn't matter because the Fed's going to jump in. They're going to backstop us. They're going to take, they are our net. Now, Fed's gone. They're out of the game. They're not buying anything. They're not pumping any money in anything, and they're not dropping rate. They're not going to pivot. So those are the conversations. And I'm hearing it real time from my clients that I'm working with all around the country that are, trying to secure debt for acquisitions right now. Banks are changing in real time quickly, where, the other day they were doing 80% LTC. Now they're doing 60, and they were looking for, 12 months reserves. We're looking for 18, but, same thing happened in the pandemic. Lenders tightened and till they understood what was going on. So it's just how it worked. The key is every bank's different. Every loan committee is different. Every underwriter is different at those lending institutions. So this is when you got to really start broadening your net and talking to everybody. And that's where you can really gauge it. And that's what I love about banks. A lot of people hate banks. I love them because they are a great gauge of what the economy in real time looks like, because they're basing their decisions on credit that they're issuing to their businesses, their business clients, and their banking clients, like commercial credit, business lines, things like that. So they know what default rates look like there, what kind of pressure that the general public is under or not. And they're also looking at, their loans and how they're performing, things like that. So they've got a real pulse of what's going on, local and regional banks in these areas. The bigger banks, a little bit different, and they're more like Fed reactive kind of banks. But, talking to local and regional banks, you can get a lot of insight to what's going on in real time in the economy, because that's who they're talking to out in the streets, and businesses and consumers. And, they understand, when real stress is showing up in the real estate market.
That's probably the best nugget homework for everybody. It's a time when you need to do it and then put it in motion. And bankers are available.
With REO department, special assets managers. That's what they're called at the banks, special assets managers and REO department. And start having a regular follow-up with them. Go to lunch, whatever, call them on the phone and just, see what's going on out there, what their loans look like and what they're seeing. That's where you're going to get the first opportunities as well as the first indications of what the market's really doing.
Love it, Greg. You're amazing. I got one last question. How did the Navy help you in real estate, get through a bunch of this stuff? What's something specific?
Yeah, so I went in the Navy right out of high school, did not go to college. So, first of all, discipline, standard operating procedures, chain of command systems, all of those things, but discipline more than anything else. Discipline meaning doing what you need to do, no matter how you feel about it, whatever it takes, you
Yeah.
get the job done. So that's discipline. You just do it.
Yeah.
There is no other option. Failure is not an option. You just go. So that's number one. Number two, systems, standard operating procedures, preventative maintenance, so taking care of things so that the things will take care of you. And that's your business. You take care of your business will take care of you. Take care of the people in your business, they will take care of the business for you. Take care of your customers, everything else is going to work itself out. So, those types of things. I did get some retail training. I did retail in the Navy, so I did get some business training, accounting, and
Yeah.
things like that. But those were the lessons that I learned for my time, and then just had a blast seeing the world.
Yeah, I bet. It's really amazing. Wish we had some more time. But Greg, your knowledge is just fantastic. Thank you for sharing here.
Yeah, absolutely. Let me know if you want me to come back, and maybe we can talk about some real estate development. We didn't even get into that today.
Yeah, no, it's just so timely. I would love to have you back. And here, guys, look at the show notes, contact Greg, go through his stuff, and we'll have you back. But really appreciate it.
Thanks for having me.